Hello traders, welcome back to the Forex Geek, where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the Implied Volatility Index, also known as the VIX Index. This powerful indicator is often referred to as the fear gauge of the market, and understanding how it works can give you a significant edge in navigating the market volatility. So by the end of this video, you will not only understand what the VIX is, but you would also learn a step-by-step strategy to use it effectively in your trading. So stay tuned until the end, because this could be a game changer for your trading journey. So the Implied Volatility Index, commonly referred to as the VIX, is a real-life index that measures the market expectations for volatility over the next 30 days. It is often called the fear gauge because it reflects the level of uncertainty or risks perceived by investors in the stock market. So this VIX is calculated based on the prices of the S&P 500 index option, which are financial contracts that gives the traders the right to buy and sell the index at a predetermined price within a specific time frame. So we ask ourselves, what does this VIX measure? And the VIX measures implied volatility, which is driven from the option price rather than the historical price movement. It reflects how much traders expect the S&P 500 to fluctuate in either direction over the short term. Importance: it does not predict whether price will rise or fall, but instead it indicates how turbulent or stable the market might be. So when we have a high VIX value, this often occurs during the period of market stress or uncertainty, signaling increased fear among investors. And when we have a low VIX, this suggests calm market condition and lower perceived risks. Now let's see how we can trade with the Implied Volatility Index. Now let's look at a step-by-step strategy that has been tailored to use the VIX in our trading. First, by identifying the extremes, knowing that the high level often occurs during period of panic or heightened uncertainty in the market, whether it is oversold and could be nearing a reversal. The low VIX levels, this suggests a complacent in the market, which could precede a period of increased volatility or potential market pullback. Now the second step is to measure the market, or to analyze the market correlation. And the VIX typically moves inverse to the S&P 500. When the S&P spikes, when the VIX indicator, when the VIX spikes, it often correlates or coincident with a decline in the stock market. Conversely, when the VIX drops, it usually aligns with stable or rising market. So looking at this area presently on my chart, when the VIX is dropping, you can go to the S&P 500 and you can see the S&P 500 is increasing at this particular time in the market. You can see it is increasing particularly in this time in the market. So when the S&P is increasing, the VIX will decrease, and when the VIX is increasing, the S&P 500 will reduce. So we look for divergence between the VIX and market price action. For example, if the S&P 500 is falling but the VIX is not rising as expected, it may indicate reduced fear and a potential stabilization in prices. So the third step is to develop a Qatarian for your trade setup, because the VIX is mean reversing. Extreme levels can provide Qatarian trading opportunities, like the high VIX level, consider bullish setup. So when we see a high VIX level, we consider bullish setup. For example, you look for a technical confirmation such as support and resistance support levels or bullish candlestick pattern before entering long. So when we see the price is going to the upside, we always enter when we see bullish confirmation, or when we see support levels, areas where price might come to retest before you would want to enter a long position. Then when you see a low VIX level, always prepare for a potential market correction by identifying bearish setup like resistance zones or overbought conditions on the technical indicator. So when you want to take a sell trade, you just look for your resistance levels in the market. Look for your resistance levels. This signifies a low VIX level. Remember, there is a correlation within this pair and your S&P 500. The fourth step is using option strategy based on volatility. The VIX directly impacts option pricing, making it essentially useful for option traders. You can adjust your strategy based on whether your implied volatility is high or low. High volatility or high VIX, selling options strategy such as credit spread or covered call to take advantage of inflated premium. Avoid buying options outright as high implied volatility increases their cost. While for a low volatility or low VIX, we buy option strategy such as long calls or puts to potential benefit from future volatility increases. And we also avoid selling options when our premium are low, as they offer limited reward relative to the risks. So if we compare this using our options, we can see what we are talking about at this area. Fifth step is to monitor the VIX term structure. The term structure of the VIX future, comparing short-term and long-term contracts, can provide additional insight. So the backwardization, which is short-term future higher than the long-term, this often occurs during a market stress and may signal a potential bottom. Then the contango, this is when a long-term future is higher than the short-term future. This reflects normal condition but could indicate complacency if too steep. We can also combine with other technical indicators. This is the step 6. You can always use the VIX alongside technical indicators for confirmation. For example, you can look for a divergence between the VIX indicator and a momentum indicator such as your RSI on major index. This is how this can actually help us to get a correlation between this pair and certain other pairs. We can also use support and resistance level on price charts in conjunction with the extreme VIX reading to identify entry points. The seventh step is to implement risk to reward management. You would have to always incorporate risk management into your strategy when using the VIX. Market condition can remain volatile longer than expected, so a stop loss level and a position size accordingly should be used. Using a trailing stop to lock in gains during period of decline volatility after trading your entry. So if you are using your VIX to give you a signal to enter other pairs, you can always make sure to use a stop loss just in case the VIX is giving you a declining volatility signal or giving you period of gains and period of lagging. You'd always have to use a stop loss to capitalize on your moves when it has moved in your direction. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, share, subscribe and turn on the notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching and I will see you in the next video.